The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltales Weekend Update. I'm Ava Cavett.
And I'm Marcus Graham, the cash flow desk.
Quick note, the show is produced entirely with AI tools, and both voices you're hearing are AI generated. Send feedback through the Substack. Micron just proved what it looks like to win the right side of a technology cycle. Intel proved what it looks like to lose one. Same week, same memo page, completely different cash flow statements. One company's free cash flow is up almost 900%, the other's is negative. And it wasn't just semiconductors. Comcast, Charter, and T-Mobile all got hit with the same question from Wall Street this week. What happens to your subscriber base when a satellite can do what your cable line does? Two banks think it's a real problem. One thinks it's overblown. We'll get into who's actually right, per the numbers. On Wednesday, Hunt, Jason, and Mike ran their mid-year predictions scorecard, grading calls on pharma M&A, the AI build-out, and Tesla's robotaxi race against Waymo, closing out the full review without needing a second week. This weekend, two different incumbent stories, who's getting outflanked and who's spending like they know it. On page 6 of the cash flow memo this week, Comcast, Charter, and T-Mobile all got the same verdict delivered from three different directions. The threat has a name now, Starlink. It's been a hypothetical for 2 years. This week, for the first time, the sell side started putting actual subscriber loss numbers on it instead of just gesturing at the risk, and the three companies are responding to that same threat in three completely different ways. Comcast is dealing with it by spending on two fronts at once. Comcast-owned Sky agreed to buy ITV's media and entertainment business for up to £1.6 billion, roughly $2.1 billion, with a £200 million earnout riding on future ad performance. Closer to home, Comcast also hit a construction milestone this week, wiring 15,700 new homes and businesses in New Jersey for Xfinity. The fiber build going one direction while Wall Street models the satellite bleed going the other. And that's the real story. Morgan Stanley cut its Comcast price target to $30 from $33 this week, now modeling Starlink at 16 million U.S. broadband subscribers by 2030, costing Comcast and Charter combined 400 to 500,000 broadband subscribers a year. Marcus, is 6.5 times too cheap or exactly right?
Comcast is the cheapest stock in the entire memo, and the market's telling you exactly why it's willing to leave it there. 6.5 times trailing free cash flow on a 15% yield. Free cash flow was already down about 21% year over year going into this. That's not a value stock. That's a stock priced for a shrinking subscriber base. And this week, Morgan Stanley just told you how much more shrinking they expect. The test is whether the ITV content actually slows the bleed, or whether Morgan Stanley's subscriber loss estimate turns out to be the optimistic one.
Charter's getting hit even harder. And it's not just one bank. Barclays slashed its price target from $200 to $130 this week, and Wells Fargo cut theirs too, citing the same deteriorating broadband trend. Charter also confirmed it's shutting down a network operations center team this week, cost-cutting on the ground while two banks cut targets on paper. The one piece of good news, a California regulator recommended approval of Charter's $34.5 billion acquisition of Cox Communications, clearing a real hurdle toward closing. Marcus, the cash flow take.
Charter's the one carrying real balance sheet risk in this story. 12.5 times trailing free cash flow, but the number that actually matters is leverage. Debt to free cash flow at 10.5 times. Free cash flow's already down 12% year over year. That kind of price target cut from Barclays in one note isn't analyst noise. That's a bank telling you the subscriber math and the leverage math are now the same problem. Watch the leverage ratio, not the multiple. That's what breaks first if Cox doesn't close clean or the bleed accelerates.
And then there's T-Mobile, the one name in this trio Wall Street can't agree on. Bank of America upgraded T-Mobile to buy this week, 220 price target, arguing the market is straight up overreacting to satellite fears. 2 days later, Wells Fargo initiated coverage at equal weight, 170 target, citing Starlink as a real threat to postpaid growth. It wasn't a clean week operationally either. A network outage on July 7th hit more than 2,000 users, and in the middle of that split analyst decision, T-Mobile also lost a 28-year veteran. Chief Business and Product Officer Mike Katz stepped down, staying on only as an advisor through December. Marcus, who's actually right here.
T-Mobile's the only one of these three actually growing into its number. Just under 16 times trailing free cash flow, and free cash flow's up 6% year over year. Not down, up. Management's still buying back stock, 12 billion trailing 12 months. That's not a balance sheet bracing for a satellite hit. Bank of America and Wells Fargo disagree because the numbers genuinely don't show the damage yet at T-Mobile. The disagreement is really about which cable and wireless name gets hit first, and right now, T-Mobile's cash flow statement is voting with BOFA.
Verizon's in the same boat, for what it's worth. Wells Fargo started coverage there this week, too. Same Starlink logic, same equal weight. Three telecom names, one satellite story, and completely different balance sheets underneath it. Same page of the memo, three different answers to the same question. The deep dive this week is page 3 of the memo. Micron and Intel, same industry, same 7 days, opposite direction entirely. Both companies make chips. Both are spending tens of billions on U.S. manufacturing, and this week, one of them got paid for it and the other got punished for it. One company just told the market it's betting $250 billion on a supercycle that isn't slowing down. The other just watched its oldest rival pass it in the one number that was supposed to be safe. Micron raised its U.S. manufacturing commitment to $250 billion through 2035, $50 billion more than the number it announced earlier this year, and poured first concrete at its new fab in Clay, New York, more than a full quarter ahead of schedule. It also put another $3 billion into the domestic supply chain this week, including financing to Global Wafers for a Texas wafer facility. Intel had a rougher week, and it actually started on a high note. Intel stock got an early lift Monday when the Broadcom-Apple chip deal triggered a broader semiconductor rally, up 5% on the read-through. That lift didn't last. Reports surfaced that its 18A and 18AP manufacturing nodes won't hit profitable yields until late 2026 at the earliest, more likely 2027. The stock dropped nearly 10% on July 7th, another almost 8% on July 8th, a 21% decline in 7 trading days. And in the same window, AMD reported more first-quarter data center revenue than Intel for the first time ever, $5.8 billion to Intel's $5.1. Marcus, start with Micron.
Micron just repriced itself without anyone noticing because the earnings caught up to the multiple instead of the multiple getting cut. The memo has Micron at about 41 times trailing free cash flow now on $26 billion of trailing FCF, up about 879% from a year ago. That's not a stock getting more expensive. That's a company whose cash generation exploded faster than the stock price did. The pledge increase and the ahead-of-schedule fab are Micron telling you it believes this isn't a one-quarter DRAM spike. Watch whether pricing holds through the next print. That's the whole bet.
Now, the other side of that page.
Intel didn't lose the data center chip war on a spreadsheet. It lost it on a delayed process node. CapEx ran about 13 billion trailing 12 months, and none of that spending has translated into a profitable 18A yield yet, which is why free cash flow is negative and there's no honest multiple to put on this stock right now. The number that actually matters isn't a valuation ratio, it's 5.8 billion versus 5.1 billion, AMD over Intel in data center revenue, a line that has never crossed before. The test isn't the next earnings beat, it's whether 18A actually yields profitably on the 2027 timeline this report just laid out. Same memo page, same week. One company's balance sheet just got permission to spend more. The other's still waiting on a process node that isn't yielding yet.
Micron's betting on being early. Intel's betting on catching up. Mark the next print for both. Rapid fire. 2 more stories this week. No deep analytical beat. Just the signal. Quick. Next Era Energy filed the paperwork on the biggest utility merger of the year. The SEC S4 went in on July 9th, roughly $67 billion. Next Era absorbing Dominion Energy, each Dominion share converting into Next Era stock plus a cash payment, targeting close in the second half of 2027. Here's the tension. the cash flow memo already had NextEra's free cash flow down 65% year over year before any of this. They're announcing the sector's largest deal in years off a balance sheet that's already stretched. NextEra reports its own second quarter numbers on July 24th. That's the print to watch for how this financing actually gets structured. Apple and Broadcom extended their chip partnership through 2031. $30 billion, more than 15 billion U.S. made chips, including a $1.5 billion facility expansion in Fort Collins, Colorado. Apple's already sitting at about 35 times trailing free cash flow. This is a company paying up for supply chain certainty, not hunting for a cheap deal. Same week, the EU's top court rejected Apple's appeal and upheld its gatekeeper designation under the Digital Markets Act for both iOS and the App Store. Broadcom, on the other side of the chip deal, got downgraded to hold by Erste Group. Their read is a 35 times forward multiple against NVIDIA's 22, even with the strong margins. One company paying for certainty, one company getting told its certainty is already priced in. Apple's own Q3 print lands July 30th, off guidance of 14 to 17% revenue growth on iPhone 17 demand. That's the number that tells you whether paying for certainty was worth it. That's the show. Wall Street's consensus on cable and wireless. Satellites are coming for all three names the same way. Two banks agree on Comcast and Charter, but Bank of America just broke ranks on T-Mobile, and this week, T-Mobile's own cash flow statement backed them up. Consensus isn't as unanimous as the headlines make it sound. And on chips, consensus likes to treat memory and logic as the same semiconductor story. Micron and Intel just spent a week proving they're not. One's compounding, the other's now pricing in a 2027 turnaround instead of a 2026 one. Forward week, earnings season builds fast. JP Morgan and Goldman Sachs both report Tuesday, the first real read on how the banks are pricing credit risk into the back half of the year. ASML drops Wednesday, and Morgan Stanley reports the same day. Thursday is stacked. Taiwan Semi, Netflix, and United Health all in one session. Taiwan Semi in particular is the real test of whether Micron's supercycle story extends to the rest of the chip complex or stays a memory-only story. Hunt, Jason, and Mike are back Wednesday on episode 2629. Download the cash flow memo at telltales.us. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase, or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.